Okay, let's get started. So I'm going to talk a bit about history, and sadly I have to admit that most of it is within my own lifetime, meaning that I'm old. But unlike a lot of old people from TradFi that come to talk to people about crypto, I'm not going to sit here and just lecture you and hector you like Elizabeth Warren and say, oh, you guys did all this stuff wrong, and we need to fix it, and we need to be more like the banks. That's not the case at all. But there are issues, and there are things that we need to learn, so let's dive right in. So we all know what happened over the summer in terms of facts. We know Luna and UST collapsed. We know that $60 billion got lost at the peak, although in reality, that's probably not the right way to measure it. We know that the GBTC and AV trade collapsed. The discount moved over 30%. We know that staked ETH's discount widened dramatically. And we know that those caused a knock-on effect. We know 3 Hours Capital failed. We know that Voyager and Celsius have failed. We know that multiple firms announced massive impairments, and that sounds bad. But what does that really mean? Well, the real issue is, and what happened is that millions of clients lost money without having a flipping clue how or why they lost money. They had no idea of the risks that were being taken, and that is a serious problem. Regulators do not like that stuff. But we also know that public confidence in crypto is down. So what have we seen? Well, we see as a result, we see higher correlations to TradFi markets. So when NASDAQ and Russell go down, crypto goes down, and vice versa. Why? Because there's a higher percentage of people that are really speculating as opposed to long-term holders. The other thing we've seen is FUDsters, people who talk about the environmental problems, they've all gone crazy, yada, yada, yada. We understand this. So the important point here is the market really needs to evolve and needs to understand what is happening. But there's good news too, and this is really not understood by most people in TradFi. The crypto market has spawned a bunch of innovations, several of which are really important. Fully backed stable coins, they all work really well. DeFi protocols worked really well. The human ones, not so much, but in terms of lending, but the DeFi protocols did work. We know that the marketplaces worked well in terms of, whether it's whichever exchange you mentioned, handled the volume and volatility extraordinarily well. Most important, the real-time risk engines of the exchanges, particularly FTX and others, handled volatility extraordinarily well. You did not hear about any bankruptcies opting over crypto derivative trading for a reason. For the most part, losses were contained to the collateral that was posted. This is going to matter a lot. But to understand why this matters, let's go through history. So first, we're going to start in 1983. Now this one's fictional. This is Duke and Duke from the movie Trading Places, which is my favorite movie of all time on financial markets. At the end of this movie, the bad guys get wiped out completely. Why? Because their futures positions on the COMEX all accounts had to be settled at end of day. Their losses were not limited to the collateral posted, but went to the entirety of the firm. Now you might think this is, well, it's a movie, it doesn't happen. Stay tuned. Let's go to 1987. What happened? Largest one-day drop in U.S. market history in percentage terms, the crash. I was actually on the desk at this time. I had built program trading systems for Morgan Stanley. It was caused by a combination of things, caused by overextended markets, sure, and a liquidity crisis because of something called portfolio insurance. Now, what this was matters, and in crypto, you should understand this, because what it was every firm, there are probably 20, 30 firms, sold this thing called portfolio insurance. And every one of them said, I will be able to ensure that you can get out at a price by looking at the average liquidity available in the futures markets. So now you had 20 to 30 firms selling the exact same liquidity. So of course, in the morning of the crash, what happened? 20 or 30 firms started all selling the full amount of liquidity on the futures markets. Obviously, it pinwheeled down. Now, we're used to this in crypto in terms of liquidity cascades, but this happened in the largest market in the world, and it was a very, very big deal. Then, the second whammy happened at 3 in the afternoon, when all the retail firms had their single point-in-day margin calls, and all of a sudden, they had to start selling assets for all their retail customers. At that point, there were no buyers, and had the market not closed at 4 o'clock, it would have kept going down. And that caused lots of panic. There were markets around the world that didn't open for a week after that. So what was the response to this? Well, they put in circuit breakers and said, okay, we're going to stop the market. One could argue that that's not such a great idea. It's basically almost never been used, a couple of strange occasions. But the most important thing that happened from the crash is it slowed technological innovation. The fear was markets move too fast, and so they slowed it. I sat in a room with a bunch of technologists in 1990, and all of them said the markets would be fully electronic in a year or two because the technology existed. I said, no, the banks don't want that because they make too much money by wide spreads. So what happened? It took 15 years for markets to go fully electronic. Important to understand who we're fighting in crypto. It's the exact same forces. 1990, another interesting case. Drexel Burnham goes bankrupt. Now Drexel, if you don't know the story, was the most profitable firm on Wall Street in 1986, earning over $1 billion in today's dollar money, based on inflation rate. 4 years later, they were gone. Poof, vanished. Why? Combination of three things. Competitive pressure, rising rates, and regulators that were basically openly hostile to them. Now, I'm not going to make a comparison with large publicly traded crypto firms, but it can happen. It is important, and people should be very well aware of the historical parallels. 1994, Orange County goes bankrupt. Probably haven't heard of that one either. Orange County was the first municipality in the United States to go bankrupt. Why? Because for years, they had had one of the most aggressive derivative trading platforms. They were betting leveraged, well, they got the ability to trade leverage, on interest rates continuing to go down. When the rates started to rise, they started losing money. Because they were leveraged, they lost all of it. They didn't just lose what their investments were, they literally lost over $1.6 billion, which to Orange County at that time was a big deal. What's happened since then? Well, of course, they're banning leverage for municipalities, but the lesson about what happens when you over-leverage has still not been learned. 1995, here's where trading places gets real. Barings Bank, one of the oldest banks that banked the queens and the nobility of England, one of the most conservative outlets anywhere, goes bankrupt. Why? Because Nick Leeson, trading on the Singapore Futures Exchange, made bets so big that the entire firm couldn't handle it. Now, it's really important to understand that if Nick Leeson tried to do that on FTX, he couldn't do it because his posted collateral is all he could lose. Sure, he would have been liquidated, but the firm wouldn't have gone under. And this is extremely important because as people look at the CFTC and the rules that are being proposed by FTX, understand what's at stake. Rules like we have today allow unlimited loss for firms. Rules that we have in crypto do not. And that is a very, very big deal. 1996, there's a collusion scandal. You can see the 90s were a fun decade for me. It was a collusion scandal on NASDAQ. The dealers were holding spreads artificially wide. At the time, they were fighting tooth and nail against electronification of markets in the States. During this period of time, and it was a really funny transcript and there's lots of stories, they were doing things like holding spreads at a quarter, and if you had a spread, you tried to bid higher, they might call you and say, hey, lower your bid, I got someone I need to sell to. And so this sort of thing happened, and what came out of it was electronification. The important point here is, at the time, a market that was dominated by people, at the time it was using phones, not Skype, and not Telegram, but it was using telephones, was trading mostly with dealers, sound awfully familiar to the way crypto trades in many cases, was done with artificially wide spreads. The market makers are the most profitable. Alameda, B2C2, ring a bell? But anyway, all of these things were happening. When that stopped, and when electronic trading came in, over the next 10 years, spreads and costs dropped by over 90%. Volumes went up by over 10x, probably closer to 15 times. It proves a very important point. If we want crypto to continue to grow, we need to let trading costs go down. Now, this is the only advertisement I'll make for CoinRoutes, but that is literally the only thing that we do, is we focus on helping people, our institutional trading partners and clients, trade cheaper at lower cost. And with the market structure in crypto, it is doable, but once again, it is not a majority opinion. Let's go back to the history. 1998, long-term capital management needs a $3.65 billion bailout. The smartest guys in the room, Nobel laureates, people that everyone look up to. Now, it was on the other stage last year, someone who was up there failed, and the only reason that what happened there was worse was because his creditors were smaller than him. In the case of long term, they were the biggest banks on Wall Street who all ate these losses, and they were bigger than them. Why did it happen? Well, because they thought they were smarter than everybody else. They outsized their bets, and eventually leverage caught up to them. Sound familiar? 2000, the dot-com NASDAQ bubble burst. Now, this one's really important for our regulator friends, because in addition to 78% drop in the large cap NASDAQs and 95% drops in some of the others, and lots, I mean hundreds, if not thousands of smaller firms being wiped out completely, a lot of that activity took place on OTC pink sheets, things that had very little oversight. All of them were securities, every flipping one of them. So anytime someone tries to tell you that if crypto were securities, that these things wouldn't happen, it's logically and completely false. In fact, pumping and dumping is a game as old as time. I encourage anybody to read Reminiscences of a Stock Operator, and they talk about how pumping and dumping was going on in the 1870s. You know, we've seen the movie The Wolf of Wall Street, talking about Jordan Belfort. There are movies about boiler rooms. All of these things were true. It is something that is not going to be stopped because it's human nature to do it. The only answer is yes, we should have enforcement of fraud. That is true. And speaking of fraud, 2008 has a couple of fun ones. Madoff's fraud is exposed, the largest Ponzi scheme ever. Yet why did it take so long? It took so long because he had so much respect. He used to run the NASD. And so people said, oh, well, the regulator said it couldn't be him doing this. True story. I was running statistical arbitrage for Citi. Citi was evaluating investment in Madoff and asked me, gave me the return series, said, is this possible? Well, we did the math and said, nope, not possible. They said, so should we not invest? I said, well, I don't know that it's fraud, but I do know that it's literally impossible. I wouldn't invest. So being Citi, what did they do? They cut the amount they were going to invest in half and lost only half. But that's fairly typical of what goes on in those firms. Speaking of those big firms, Lehman Brothers in 2008 is the last one that we'll talk about, largest bankruptcy in history. Once again, what was the cause? Leverage. They were overly levered, $680 billion in assets supported by $22.5 billion in capital. The losses in subprime and real estate, we all know what the cause is. It doesn't matter what the cause is. If you're over-levered and you don't have to put up collateral in advance, very bad things can happen. What's important about Lehman, though, is that there were many, and I mean many, many people who thought it was impossible that a company that big could go bankrupt. Too big to fail gets bandied around. The reality is it's never too big to fail. The one change that happened after Lehman is the word counterparty risk became part of the lexicon. If there's one thing that the crypto market should learn from TradFi, then I would say it's counterparty risk. Understand the risks that are being taken. So what does all this mean? Well, the single most important thing is you should know what your risk is, and you should make sure your client should know what your risk is. Any role should be observed, should be disclosed. Counterparty risk should be understood. We understand that. Trading costs are important, and we should continue to focus on it, and we can't really ignore history. But the most important bit here is it's two ways. We can learn from crypto in traditional finance, because as I tell people in the regulatory community, crypto is an incredible laboratory. We have a world with no constrained tick sizes, with no constraints on fees, with no bans on locked and cross markets, and yet we process at CoinRoutes 10, 15 terabytes of data a day, depending on how much volume there is. And I can tell you it's the most transparent market in the world. And if you trade it right, you can trade it at a very, very low cost. As a result, understanding on both sides needs to happen. But putting your faith in crypto operators who don't tell you how your money is being made is a prescription for disaster. And if you walk away from this learning only that, then I've done something today. Wow, I came in under time. Amazing. Thank you.